Here's a short problem on corporations, and what you see on the screen here represent the T accounts over on the left for the corporation. There might be some accounts that you've not seen before. In the middle are the descriptions of the transactions, and I've got kind of a live trial balance here. So as we go along entering the transactions, if you look over to the right, you'll see the debits and credits entered in as they get updated. So let's start here with transaction 1, and corporation issued 10,000 shares of $5 par stock, but they didn't just get $5, they got $8. So it's 10,000 shares at $8 that came in cash. That's going to be a debit to cash for $80,000. And notice over here in the trial balance, we now have a balance for cash. However, we're not in balance. The 80,000 is offset by 2 credits. The par value is $5 for each share, so it'd be 10,000 shares at 5, or 50,000, and that goes in the common stock account, and the rest goes in something called paid in capital in excess, so that'll be for 30,000. You only put the par value in the common stock account. The rest of it goes in the paid in capital in excess. By the way, paid in capital in excess is not income for the corporation. It is just extra paid in capital. All right, let's try transaction 2. The company purchased $40,000 of equipment, and they issued a note payable for that. So find your equipment account, make a debit, asset going up for $40,000, and a credit to notes payable for the same amount, $40,000. Check your trial balance. You can check it over here, or I've got kind of a quick trial balance here in red, and we are still in balance. Transaction 3. Now we're going to have some revenues. The revenues were $120,000. Now I'm just using an income summary account, and I'm going to put the revenues on the right. Revenues are always credited when they increase, following your rules up here. A revenue increases stockholders' equity, so it has to be credited. And the revenue is $120,000. And how did it come in? They received cash of $40,000, so that's a debit to cash for $40,000, and the other $80,000 is in accounts receivable. All right, so are we still in balance? Yes, we are. On the flip side of income summary, the debit side, the expenses reduce owner's equity. According to the rule, you got to make debits for that situation, so the expenses go here. And it was $90,000 of expenses. Make a debit to the expenses account, and they paid $70,000 in cash, so make a credit to cash for the payment of those expenses, and the rest is going to go into accounts payable, so that would be accounts payable credit for $20,000. So the expenses were partially paid, and then we had liabilities increasing for the remainder. All right, are we still in balance? Looks good. Now, one of the things about a corporation is that a corporation must pay income tax, and in this case, they pay it based on the earnings before taxes. If you look at your income summary, you can see the net income. See if I can point that out to you. Here's the net income so far. It's $30,000. And in transaction 5, we're going to pay tax on that income at the rate of 40%. That would be 40% of $30,000. So that would be $12,000, and the income tax expense is an expense. So $12,000 here is going to be income tax expense. And that's going to get paid in cash, $12,000. All right. Then notice that our earnings after taxes, which we would call the net income, is actually $18,000. In a corporation, the net income or net loss is always closed to retained earnings. So I'll just kind of indicate that. We want to move that $18,000 to retained earnings. That's going to be, it's going to require a debit to income summary to close it. And let's see if I can do that here. Okay, debit to income summary for $18,000 and a credit to retained earnings for $18,000. There we go. All right. Notice that the income summary ends up with a zero balance, and we are now in balance here, it appears, at the moment, $158,000 on the debit and credit side. One last thing in this story, transaction 7, a corporation may decide to pay a dividend. And I wanted to demonstrate this. Dividend is paid at the rate of 10 cents per share. Well, at the beginning, we issued 10,000 shares, and so we're going to pay out 10 cents to each share. The stockholders who own those shares will get 10 cents for every share they own. If you multiply 10 cents times 10,000 shares, you're going to end up with a dividend of $1,000. And that dividend is a debit to retained earnings. So we move the net income to retained earnings, but if we pay a dividend, that comes out of retained earnings, and we are going to pay the dividend in cash. All right, so 7 pretty good transactions there for a corporation. Couple of things here. We end up with $157,000 on both sides of the trial balance. Notice the income summary ended up at 0. It always must at the end of the period. Down below, if you wanted to make a balance sheet, I didn't have time to illustrate that here for lack of screen space, but your total assets are going to end up at $157,000. You could add these 3 balances here for your 3 assets and get that figure. Your notes payable and accounts payable add up to $60,000. And if you add the common stock, the paid-in capital in excess, plus the $17,000 of retained earnings, that'll give you your total stockholders' equity. And if you did a balance sheet, it would indeed balance. Assets equals liabilities plus owner's equity. All right, that's a speedy trip through a pretty good example there. Thanks for watching, and see you next time.